you buy gold as an alternative to U.S. dollars or U.S. treasuries. Foreign central banks are selling their dollars and buying gold. And why are they doing that? They're foregoing the interest that they could otherwise earn on treasuries to own a non-interest bearing asset like gold. Well, the main reason to do that is if you believe inflation is going to be higher than that interest rate, that means you have a negative yield and you're going to lose purchasing power if you stay in dollars or in treasuries. And so they are selling and they are buying gold. Look, the price of gold in the 1970s went from $35 an ounce to over $800. Right? That's not a coincidence that happened during the year or the decade of all this inflation. And what gold is doing, but it wasn't gold that was going up. It was the dollar that was going down. Like, for example, oil prices in 1970 were about $3 a barrel. In 1980, they were $30 a barrel. But the difference was in 1970, we paid in gold. In 1980, we paid in paper. And so it wasn't that the oil price was going up. It's the money that we were using to buy oil was losing value. And so we had to pay more dollars to buy the same barrel of oil. I mean, that's why you mentioned women working. This was my comment on women, in the workforce.
Peter Schiff delves into the dynamics of investing in gold as an alternative to US dollars or treasuries, particularly in the context of inflationary pressures. Schiff elucidates the rationale behind foreign central banks' preference for gold over treasuries despite foregoing interest earnings. He argues that this shift is indicative of a negative yield scenario where inflation is anticipated to outpace interest rates, eroding purchasing power. Drawing parallels with historical inflationary periods, such as the 1970s, Schiff highlights how the rising price of gold mirrored the depreciation of the dollar. He emphasizes that inflation during that era necessitated additional household income, driving many women into the workforce not out of choice but financial necessity. Schiff further explores the consequences of prolonged monetary policies aimed at curbing economic downturns, pointing out that each attempt to mitigate the fallout from market corrections ultimately exacerbates underlying issues. He predicts a looming crossroads where the Federal Reserve must choose between fighting inflation, potentially triggering a severe recession, or allowing inflation to spiral out of control, jeopardizing the dollar's status as the reserve currency.
The main reason that so many women entered the workforce during the 1970s was inflation eroded away the value of their husband's paychecks. And so because inflation caused the husband's paycheck to lose so much purchasing power, his wife had to get a job to make up the difference. Now, part of it was also rising taxes. There was a lot of bracket creep during the 70s where inflation pushed people into higher brackets. But it's not like, oh, women were just all liberated and all wanted to work. They were liberated when they didn't have to work. They got forced to work because it was the only way to pay the bills. Now, the comment I made more recently is that that's how we basically got through that time period. We had a spare laborer. We had somebody who could come off the bench onto the field and help out. And that's how families were able to survive because they now had a second breadwinner. But now you don't have that because most families, the husband and wife already work. So what are people doing now? How are people surviving this inflation? Well, look at the jobs reports that we get every month. We have all these jobs that are being created, 200,000, 300,000. What they don't tell you is these are all part-time jobs. We are net losing full-time jobs, and they're going to people who already have jobs. So people are working second and third jobs. Moonlighting is at an all-time high in America because that's the only way that people can pay the rent or put food on the table. People don't want these jobs. The creation of these jobs is not a good sign. It's a bad sign. It's not a sign of a strong labor market. It's a weak labor market. In a strong labor market, you can make it on one job. In a weak labor market, you need 2 or 3 jobs. And that's what's going on. We have to appreciate the fact that really, in earnest, it started in 2001, 2002, after the dot-com bubble burst, right? That's when the Fed first lowered rates to 1%. I mean, Greenspan made a lot of policy errors in the 90s as well, and that's kind of why the stock market bubble got as big as it did. But the policies really, went to, the sublime in 01 and 02 with the rate cuts that gave way to the housing bubble, which led to the '08 financial crisis.
Peter Schiff is really adamant that every time the Federal Reserve messes up, it's like they refuse to let the market heal itself. He's convinced that when there's a boom, it's because of mistakes being made, and the bust is supposed to correct those mistakes. But instead of letting that happen, the Fed caves to political pressure and tries to stop recessions from occurring. According to Schiff, this just makes the problem worse because they end up creating more inflation, which only delays the inevitable pain. Now, he's saying we're at a crucial point where the Fed has to make a tough decision. They can either try to fight the inflation they caused with all their quantitative easing and balance sheet expansion, or they can just let it keep going. It's like they're stuck between a rock and a hard place, and whichever option they choose, there are going to be serious consequences.
But to do that means interest rates have to go much higher than they already are. They have to go high enough to force massive cuts in spending on the government level and on the household level. But our whole economy is based on spending right now. It's a bubble. And so they have to create a massive recession. It's not that recessions are necessary to fight inflation. It's just that what's necessary to fight inflation will also cause a recession because of the underlying nature of the economy. And this recession, which will have a housing market crash, a stock market crash, will result in a wave of defaults and failures. There can't be any bailouts like we did in '08. So when a bank fails, they can't bail it out. They have to let it fail. And they have to allow the depositors to lose money. There's no money to bail out the depositors. They have to lose. The government has to tell people on Social Security and Medicare, we just don't have the money to make the payments. We're not talking about making cuts for people in the future. The checks we're sending out right now, we don't have enough money. We gotta make those smaller. Right? Social Security, the trust funds, so-called trust funds, are already selling treasuries right now. Social Security already takes in less than it puts out. It's insolvent. So the government has to tell government pensioners, we can't make the pensions because we're broke. We actually have about a $3 trillion a year deficit right now, maybe closer to 4. I mean, even if they massively increase taxes on the middle class, I don't think there's enough they could do it. So they have to make these deep cuts to government spending. And of course, that's going to be very problematic for people who were counting on Social Security or who lost their savings in the bank. In fact, if the Fed really fights inflation, we probably can't pay the interest on the national debt because right now we're spending about $1 trillion a year on interest on the national debt. If the Fed, let's say, raised interest rates to where they need to be, given the short-term nature of the debt, within a few years, we could be spending $3 or $4 trillion on interest on the debt, which can consume 100% of tax revenue. And of course, we can't cut Social Security, cut Medicare, right, and pay the Chinese 100 cents on the dollar. I mean, that's just not going to fly. So we would have to default. We would have to tell our creditors, we can't pay you what we owe you. Well, maybe we'll pay you some discounted rate. So all these difficult things are going to happen if the Fed really does what it needs to do.
Peter Schiff paints a grim picture of the potential consequences if the Federal Reserve were to take decisive action against inflation. He argues that such action would necessitate drastic cuts in government spending, a move that would ripple through various sectors of society. For those dependent on programs like Social Security or those who have lost their savings due to bank failures, these cuts would pose significant challenges, potentially leaving many vulnerable individuals without vital support. Schiff further warns that if the Fed were to raise interest rates in an attempt to combat inflation, the resulting increase in interest payments on the national debt could spiral out of control. This scenario could lead to a situation where a substantial portion of tax revenue is consumed by servicing the debt, leaving little room for other essential government functions. Ultimately, Schiff suggests this could force the government into a position where it is unable to meet its financial obligations, potentially leading to defaults on payments to creditors. However, Schiff acknowledges the political realities that make implementing such austerity measures difficult. He suggests that policymakers may ultimately choose to avoid the pain of deep spending cuts by allowing inflation to persist. While this may provide temporary relief, Schiff argues that it would only serve to exacerbate the problem in the long run, leading to runaway inflation that erodes the value of the dollar and undermines its status as the global reserve currency. In this scenario, Schiff predicts widespread losses for bondholders and government creditors, including individuals holding dollars, as the real value of their investments is eroded by inflation. Overall, Schiff's analysis paints a bleak picture of the potential consequences of the Federal Reserve's response to inflation, suggesting that tough choices lie ahead for policymakers and individuals alike.